The biggest economy in Europe is faltering. Rising inflation, low production, and employment shortfall. The German economy is going through the worst crisis since the pandemic showdown. Join us as we take a deep dive into how the German government caused its economic downfall and why major industries in the country are shutting down. German companies are shredding jobs. For the first time in 3 years, German companies are shredding jobs. Economists had predicted that September 2023 would be a difficult month for an industry-heavy Germany. Overall, the production was supposed to drop by 0.1%. However, at the end of September, the industrial output in Germany had dropped by 1.4% compared to August. Needless to say, the data shocked the economists who were already predicting a technical recession for Germany at the end of the quarter. Indeed, the recession is a common issue in the EU. Yet, the immense loss in industrial output brought bad tidings for the largest economy in the European Union. At this rate, Germany's technical recession is unavoidable. Another devastating data from the country shows that the third quarter GDP will show a downward trend, and Germany will end its year in recession. For the past 2 quarters, there has been a sharp decline in consumer spending in the country. With rising inflation rates, locals chose not to spend extra income on furnished goods. Overall, the outlook for Germany's economy is pretty bleak, and the conditions are unlikely to improve. The industrialists are facing major structural problems that are forcing them to shred jobs. Other than the weak Chinese economic slump, the war in Ukraine has caused high energy costs and painful interest rate hikes. The existing data shows that German manufacturers are not getting enough orders for their products. And the image of the German market has earned a bad reputation for itself. Plus, most European economists don't see the conditions improving for the biggest contributor to the Eurozone. What's devastating is that the wave of unemployment has plagued the German economy once again. We saw this turbulent effect during peak pandemic stagnation as well. Now, as the German youth complete their higher education, their destiny is a competitive and restrictive job market. It's a no-brainer that German higher-ups are being criticized for many reasons. Not managing expectations and over-reliance on China are a few of them. Economists cite that Germany has been flirting with technical recession since 2022, but its reliance on Chinese markets and Russian energy imports has worsened the conditions, and the data supports such conclusions. The GDP of the country had shrank in the last 3 months of 2022, only to stagnate again in the first quarter of 2023. And to make matters worse, Germany will welcome the year 2024 under an economic crisis. And its biggest exporting partner won't be by its side: German dependency on China. As it stands today, the economic decay in China is sending shockwaves to Germany. To be fair, everyone saw this coming. Many economists had warned Germany about relying on Chinese markets for their value-added exports. In the aftermath of geopolitical tensions rising in the East, Berlin is being forced to rethink its economic ties with Beijing. But experts believe that such consideration is too late now. The data shows that China is losing its interest in German goods even after the post-pandemic relaxations. Berlin had hoped to boost trade with Beijing in a post-pandemic world. But native problems in China are on the rise too. Rising inflation and unemployment have forced the locals to rethink their consumption. After Beijing lifted pandemic restrictions, the Eurozone was hoping for a miracle. Yet, German exports in the country only made up 6.2% of the total exports in the first half of 2023. This share is the lowest since 2016. For an economy that relies on Chinese consumerism, this is a paralyzing effect. It's true that the Eurozone's reliance on China has never yielded efficient results. For the last 10 years, the Eurozone has been stuck between a rock and a hard place. The European Union has always maintained diplomatic ties with the U.S., so, of course, that relationship is always in some hot waters. The U.S.-China relations have become more tense, and Xi Jinping's support to Russia in the middle of the war has forced the EU to make some hard choices. And now it can't simply afford to rely on selling its goods to China and Russia to get out of technical recessions. The impact of this problem is inescapable for the European Union, but Germany's problem is unique. In the words of Commerzbank's chief economist Georg Kramer, for some years now, Eurozone exports to China have no longer been growing faster than overall exports, and recently they have been even somewhat weaker, which has weighed more heavily on Germany's manufacturing sector than on that of its peers. Now, there are many reasons behind this problem. The economic degrowth in China is the strongest impetus behind Germany's low exports. Besides, China has been producing the goods it had acquired from German markets. Ever since China has intensified its trade war with the U.S., it has boosted its local industries. The country is now producing quality goods like automobiles and electronics. In this large geopolitical game, Germany has suffered, though China became an important market for the Eurozone in the early 2000s. Since then, the country's manufacturing outlook has changed drastically. At the same time, Berlin can't exactly afford to deprioritize Chinese markets. You see, the large manufacturing sector in China is very important. It has everything that Germany needs for its energy transition plans. Chinese imports like raw materials to build solar panels are critical for Berlin's carbon-neutral projects. It's true that China isn't interested in buying German exports, but the Eurozone would still have to splurge on the import bill. German industries are losing business, and the response to the problem is devastating. And to make matters worse, Germany's energy shockwaves are triggering a new wave of deindustrialization. The energy shock. No wonder the IMF called Germany the worst performing developed economy in the world. And while those are some harsh words, the country's recent energy shock is harsher. The German economy reached its tipping point when it had to get rid of major Russian energy imports during the Ukrainian war. While Germany wanted to be on the right side of history, its energy-dependent manufacturing sector toppled down. After losing cheap natural gas from Moscow, the German government was only able to seek expensive imports from the U.S. In the blink of an eye, industrialists were being forced to foot colossal energy bills like they had never seen before. The most rampant impact of the war was energy inflation in Germany. While the government responded to the problem by hiking interest rates, it wasn't enough. The Russian cutoff proved to be more hefty than expected. Germany's economy relies on producing luxury cars and high-end industrial machinery. Without cheap energy imports, industrialists suffer heavy losses. Especially since Germany is looking to transition to renewable energy, its local capacity to meet energy needs is very low. According to an article published by the AP News, the price of gas is roughly double what it was in 2021, hurting companies that need it to keep glass or metal red hot and molten 24 hours a day to make glass, paper, and metal coatings used in buildings and cars. The lack of cheaper energy alternatives has triggered something unthinkable. The German manufacturing sector is being forced to deindustrialize. The new data reveals that the industry-heavy Germany is on the brink of shutting down, or temporarily decommissioning some of its major industries. Producing goods is already expensive. The Chinese slowdown and gradual recession in the European Union mean that the markets for German products are small. So how do German industrialists find a reliable clientele? That's a question that the German government needs to answer. The recent escalation in the Gaza Strip and hostility in the Middle East are two major problems in this scenario. Due to these uncertain events, energy prices are highly unstable. As of now, there's only one viable solution to save the industrial zone in the country. Economists suggest that the government would have to put price caps on industrial energy products. And this is the only way for the economy to survive the transition to renewable sources. But this is an expensive solution. Any price caps need large amounts of government funding that Germany can't afford. In the midst of a crisis, the government has been transparent about making some key mistakes. For instance, shutting down nuclear power plants in 2011 was an unpopular decision. Since then, the government doesn't have any avenue to produce electricity from a non-renewable source. Plus, it is yet to approve major projects that will produce renewable energy for the defaulting economy. And of course, the former Chancellor, Angela Merkel, is under fire for signing major import deals with Russia. Her most unpopular decision is perhaps the reliance on Nord Stream. It's still unclear who was behind the destruction of the billion-dollar gas pipeline project, but major investigative journalists had blamed the U.S. for the blast. In that case, Germany's decision to buy gas from the U.S. was met with criticism and questions. Yet for German industrialists, the dilemma remains. Do they wait for a government-funded price cap for their energy needs, or do they go home packing? After all, their only hope is the dip in the Consumer Price Index. If economics isn't your thing, CPI is a measure of the inflation rate of a country. It's true that energy prices have skyrocketed, but consumer products have stabilized since October 2023. As of October, the measure of CPI is 3.8% as compared to September's rate of 4.5%. The dip in the inflation rate has come about after 2 very hard years for the German natives. The decline in consumer prices has good tidings for the industrialists who are struggling with low local demand in the country. It's true that data is showing a major improvement in inflation in Germany, but the energy crisis remains unsolved. What's next for Germany? As of now, the biggest hurdle in Germany's progress is the European Union itself. Germany's trading partners in the EU are going through an economic slowdown too. Economists observe that the slump in Germany's economy is a spillover effect of an economic recession in the Eurozone. Due to the war in Ukraine and the Middle East, the European Union is struggling to produce industrial output. Economies like the United Kingdom and Austria have contracted in recent years. Sure, there are some anomalies like Romania, Spain, and Belgium, but business activity in the region remains low. The third quarter GDP in the year 2023 is a mixed bag, but a general trend shows that the demand for goods and services in the region has declined. The improvement in the German economy is heavily dependent on the Eurozone. Yet the country's energy crisis remains the biggest contention for the country. Do you think Germany will go back to buying Russian gas once the war in Ukraine is over? Let us know in the comments below.